Welcome to GRE. I'm your host, Keith Weinhold. We are in the midst of a housing sales crash. I talk about what that means to the future of the real estate market. Then, the president of one of America's leading mortgage loan companies joins me, where you can expect a specific interest rate prediction today on Get Rich Education. The EQRP system now allows you to shield up to $700,000 of income from taxes every year. My friend Damian Lupo informed me that checkbook IRAs have been made illegal by the U.S. tax court. So if you have a checkbook IRA, your holdings are now disqualified with taxes and penalties up to 50%. But don't panic, Damian and the EQRP team can fix this. This way you can invest your 401k or IRA in real estate, gold, Bitcoin, and even your own business. So whether you're a full-time investor, retired, or even a dentist with dozens of employees, if you're listening, you qualify. The EQRP works. It's a solution. You'll control your retirement money, kill UBIT, and pay way less taxes. I encourage you to learn more about this strategy and free up your retirement money. Get the newest EQRP special report. Text GRE to 307-213-3475. Text GRE to 307-213-3475. Mid-South homebuyers, with over 2 decades as the nation's highest-rated turnkey provider, their empathetic property managers use your return on investment as their North Star. It's no wonder smart investors line up to get their completely renovated income properties like it's the newest iPhone. Headquartered in Memphis with their globally attractive cash flows, Mid-South has an A-plus rating with the Better Business Bureau and 4,000 houses renovated. There is zero markup on maintenance, let that sink in, and they average a 98.9% occupancy rate with an industry-leading 3.5-year average renter term. Every home they offer you will have brand new components, a bumper-to-bumper 1-year warranty, new 30-year roofs, and wait for it, a high-quality renter in an astounding price range, $100,000 to $150,000. Get to know Mid-South. Enjoy cash flow from day one at midsouthhomebuyers.com. That's midsouthhomebuyers.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Calais, France to Calabasas, California, and across 188 nations worldwide. I'm your host, Keith Weinhold. This is Get Rich Education, how real wealth is built in the real world with real estate. Is the housing market difficult to figure out today? No, not really. In fact, a lot of today's direction feels rather predictable. 2020's housing supply crash helped lead to 2022's sales volume crash. Yeah, that's where we are today. The number of home sales are down 28% just from the start of this year. So we're talking about a slowdown in transaction activity. That's what this means to you. Why the slowdown? Why have the number of sales sunk faster than the acting careers of Dane Cook and Will Smith and Lindsay Lohan? Why less activity? Well, with low supply and so many current homeowners locked into these low payments, this sharp volume drop was almost inevitable. All right, people don't want to give up their homes in these low rates. First of all, 37% of homeowners, they don't have any mortgage at all. Yeah, that's the proportion of homeowners that own their home free and clear. So fully 3/8 of homeowners have no mortgage. And yes, we know that they're losing out on leverage and they're losing out on inflation profiting. But just looking then at those that do have a mortgage, according to Redfin, 85% of homeowners with mortgages have a mortgage rate under 5%. And many even have a rate under 3%. We know that. You may very well have a rate under 3% or 4% yourself if you own your primary residence. That's why so many homeowners hesitate to let go of their properties Well, this further constrains the available supply, and that's what helps crimp this sales volume. So it is this nationwide lock-in effect. And although the real estate market is slowing due to low supply and higher mortgage rates, and the season, there's also a slowdown each season about this time. It's this plunge in new listings that also helped keep home prices stable. Now, though supply and sales are both down, some media sensationalists appear to call for a bad housing price crash. I don't know if they're doing this just because that's what attracts eyeballs and generates clicks or what it is. Well, it would likely take a catastrophic event to trigger a real estate price crash like a distressed seller circa 2008. No price crash is expected. And why is that? Why is that, in fact? Why would it be difficult to have a price crash with market conditions as they are into the near future? Well, we really have a lack of distressed homeowners in this country. I've been touching on it a little bit. So, again, existing homeowners, 3/8 of which own free and clear. Well, the other 5/8, they can afford their low fixed mortgage payments. See, when your mortgage payment's fixed, inflation can't touch it. The other reason that homeowners are in good shape is that today's borrower loans are well underwritten, even those loans made 5 years ago and more. So borrowers have good credit and assets. They can afford those payments. We still have a remarkably resilient, fairly strong employment situation in the country. Of course, homeowners still have this record equity to protect. Equity levels continue to hit all-time highs. And then really to have a price crash, it is fueled by housing oversupply, a glut of supply. And again, we're in the opposite condition. There is not enough inventory. So all those factors right there that I have laid out, really, that is reflected in the delinquency rate. When we check the health of that existing homeowner, it's often reflected in the delinquency rate. Well, the mortgage delinquency rate is low, and in fact, it is downward trending. So really, everything checks out there. And there is this slowdown in overall buyer activity, but despite that slowdown, the homes that actually do get listed, they are still selling quickly. And of course, that depends on your local market. But days on the market are between 13 and 23 days, depending on the price. And in a more typical market, it is 45 days. So it's 2 to 3 times that per the NAR. Well, now that we've established the decline in sales volume, partly induced by this rate lock-in effect, let's look at housing's future in terms of price and in terms of housing's future mortgage rates. Next year, could home prices fall in some places? Well, NAR Chief Economist Lawrence Yun expects 0 or minor changes in price next year, with either increases or decreases of no more than 5%. And the only exception, what Yoon says, is California. That's where the market could see as much as 10% declines because it's so expensive there. Over the next 5 years, he expects national appreciation to be 15 to 25% in total, the total for those 5 years. All right, so that's just about right on historic norms. Now, to be real, in reality, the NAR can give some pretty rosy predictions. They often encourage home ownership, but I think that evaluation right there is pretty reasonable, and I've seen 2 other economists concur with this as well. So that's home prices. And then what about next year's mortgage rate direction? Rates are about 7% right now for the 30-year. We all know that they have more upward pressure yet. But I rarely make specific mortgage rate predictions. In my opinion, mortgage rates are harder to forecast than house prices. So, yes, my vast omniscience is rather finite here. I'm going to outsource this one today to our guest. And as I like to joke, that way someone else can be wrong rather than me. I don't think today's rather qualified guest is going to be wrong. But she is going to give us an exact prediction of the mortgage rate peak to the nearest 1/8 of 1%, and also when that should happen by, when they're going to peak, and just exactly what they're going to be. What's also interesting in today's real estate market is the share of first-time home buyers just hit an all-time low due to higher rates and prices. Yeah, now it's only 26% of all home buyers closed on their first house in the year that ended June of 2022. That's a really sharp drop from 34% the previous year. That's according to the NAR as well. So 34% down to 26%, that proportion of first-time home buyers. And plus the age of first-time home buyers, that rose to a record high 36. That is now the average age of a first-time home buyer. And this group of first-time home buyers' racial diversity also declined. So a few more market superlatives there. Of course, that problem for first-time home buyers is a good thing for you as a real estate investor, because when they cannot afford to buy, they must therefore rent from you, increasing rents. Let's talk to today's guest about the mortgage market and its future. I would like to welcome in the president and CEO of Ridge Lending Group. She's a real estate investor herself. In fact, Ridge has helped more families realize their dreams of real estate financial freedom than any other mortgage lender in the entire nation. Welcome back to GRE, Caeli Ridge.
Keith Weinhold, thank you for having me. It's always such a pleasure, sir.
Caeli, in the mortgage world these days, obviously, everyone wants to talk about higher mortgage interest rates. We know really that the direction of those has only been up since 2021. And a lot of people wonder, well, now I see that quoted 30-year fixed mortgage rate, that headline rate, but can I perhaps get a mortgage product with a lower interest rate than what the 30-year fixed offers? So can you speak to that, how to get a lower mortgage rate today?
This is top of mind stuff. I'm having this conversation all day, every day, as you can probably imagine. Just to preface, the Fed met again. Maybe we'll get into that later, share some of that news. But when we're talking about trying to find ways to capture or recapture, rather, some of our cash flow back, because as the rates have risen, we know that we've lost a little bit in that cash flow. So what a lot of people are looking at is non-QM, outside of the Fannie Freddie, outside of the agency loans, non-QM adjustable rate mortgages, maybe interest only, both of which are offering some relief. I've always been a fan of both of the ARM and interest only for reasons I'm happy to share with the listeners. As of recently, before the rates started rising, it hasn't been viable, but we're now getting into a space where both of those things are back in play, and I believe will become more mainstream as the weeks and months go on.
Talk to us about those, an ARM and an interest only product. I guess the plus side of that is how much lower is the mortgage interest rate? And then what are the cons?
So the plus is going to be the cash flow, right? We're usually going to be, it depends on the variety of variables of the loan, but you want to expect at least a 0.5 percentage point lower than what the 30-year fixed might be giving us, depending on the product again. Ideally on the ARM, we want to see a point better. It really depends on the deal. Interest only is also another way that we can extract a little bit more cash flow. If I may, let me just kind of segue into some statistical data. I know that for the last 12 plus years, a lot of us have really kind of been fixated on the only game in town being that 30-year fixed mortgage. The reason for that is that after the 08-09 crash, we've been on an inverted yield. Okay, this just means that 30-year fixed mortgages for the last 12 years have been lower than any adjustable rate mortgage. Right? Why would you take an ARM that's higher than a fixed? You wouldn't.
Sure.
Some of that is starting to change a little bit because of how quickly the interest rates have gone up this year. But let me kind of play into before 08-09, I would tell you 9.9 out of 10 loans that we would fund were going to be on an ARM because the rates they had that spread. The counterpart was going to be a 0.5 percentage point lower. Now the statistics, I think that we've talked about this together before. So let's take a 30-year fixed mortgage. The percentage of people that start with a 30-year fixed loan and make 360 payments later to pay it off is less than 1%. It's
Right.
literally a fraction of percent. So very, very, very rarely does that ever happen. I know that currently the shelf life, the average shelf life for a 30-year fixed mortgage for owner occupied, the home that you live in, is about 7 years. So we know that investors are somewhere around 5 or 6. So if you know that, and we do find ourselves back in that place where adjustables are lower rates such that it is appropriate spread, why would you take a 30-year fixed mortgage that you're going to be refinancing to improve rates? Because when rates go up, do they stay up? No. When they go down, they don't stay down, unfortunately. But we're going to be refinancing at some point. So you're not going to take a higher rate because you're going to be refinancing to reduce the rate, pull cash out. Maybe you're selling and doing 1031 exchange. So the ARM is going to start making more sense in this new cycle that we're embarking on. The second piece of that would be the interest only. If anybody has ever looked at an amortization table or the truth in lending disclosure when they get a 30-year fixed mortgage and they look to see the first 10 years of payments, how much of that is really going towards the principal, it's probably about this much, right? Very, very little is actually being applied because it's amortized over such a long period of time. The investor that's lending this money, they want their interest. They want to be assured that they're going to get as much of the interest as they can. You're not plunking down to the principal until the back end. So for those two reasons, I've always, under normal circumstances, been a big fan of the ARM and the interest only. And we're starting to see that become more prevalent in how we can attract more cash flow.
If you as an investor are looking at that typical 5 to 6 years for the period of time in which you're going to hold onto a loan product, it's really difficult, exceedingly rare to find any 5 to 6 year period where real estate is not up on a nominal basis. That's for you in case you have concerns about refinancing after that initial, say, 5 to 6 year hold period.
Absolutely agree. The forecast for this, rates are up. I believe they're going to continue to go up, and we'll maybe spend some time on that too. But in the next 2-3-ish years, the math is going to be fairly simple to figure out when it's going to be time to refinance based on the cost of the refinance and the savings and the rate that you started with versus the rate that you're going to get. But I can almost guarantee you that for investors especially, the vast majority, over 90% of the mortgage that are secured today are going to be refinanced in the coming years.
Yeah, that makes a lot of sense. And in fact, Caeli, I've been wondering, is the reason that the spread of the 30-year fixed rate mortgage is so high above the yield on the 10-year T-note right now, is that because banks are pricing in that as a sort of risk premium because they're afraid that they're not going to be able to collect very much interest from the borrower because that borrower might run a refinance in just say 2 to 3 years in case rates go down then. So therefore lenders are building in that cushion above the 10-year T-note, greater than that traditional 1.75% average cushion?
Very nice, Keith. Absolutely right. And just to kind of take that further for those of you that might not be totally clear, what Keith is talking about is that when we talk about mortgages from a mortgage-backed security perspective, as an investment that is bought and sold and traded on Wall Street or secondary markets, right? It's important to understand that interest rates being as high as they are right now, the servicers of these mortgage-backed securities are paying a premium for the right to service these loans. The premium that they pay typically will start becoming profitable in about 3 years after they purchase the mortgage-backed security. So think about that. They need to wait 3 years before what they've paid as a premium for these mortgage-backed securities for them to become profitable before they're back in the black. But interest rates are high and they know they're going to pay off before that 3-year period of time. What does that mean? They're not going to be profitable. They're going to take losses. So one, yes, that's why the interest rates are higher. And then also the points associated with especially investment properties right now are in excess of what we've seen before. That premium pricing where you used to be able to get a 0-point loan, you're not getting that today for that very reason.
That makes a lot of sense. Okay, so lenders trying to hedge themselves, being sure that they're compensated in fees since they fear that they might not be able to collect enough interest over the years, since one can make the case that in 2 or 3 years, mortgage interest rates could be lower than they are now. And in the United States, unlike almost any other nation in the world, you, the borrower, are in control of that loan. You can refinance pretty much when you want to refinance, as long as you have adequate equity and credit, of course. With that in mind, Caeli, can you speak any more about how one can get a lower rate than a 30-year fixed rate loan? Maybe how you would guide someone and show someone what their options are if they want to put 20% down on a 1 to 4 unit income property right now and yet not pay that 30-year fixed rate.
First, I'm going to find out what their goals are, short and long term, and then we're going to look at the variety of loan products available to them. And I would say even keep the 30-year fixed in the mix, right? So we'll look at the numbers for this, Maybe we look at the all-in-one, which is one of my favorite products. Maybe we look at a 5-year ARM, an interest only. And then side by side, it should be pretty clear to us based on the goals and this particular investment. It's going to be different for every opportunity that they're looking at, which is going to make most sense. So the ARMs and the interest only typically is where they're going to find the lower interest rate. And then we can talk about buying down points too, but more often than not, I'm going to say buying down further beyond the points that you have to pay right now to get the loan probably doesn't make a lot of sense, especially since we're going to be refinancing fairly certainly in the next few years.
Why don't you tell us? You offer so many products beyond just the 30-year fixed rate plain vanilla loan, and you deal specifically with investors. I mean, you are specifically engaged in helping real estate investors, not principal homeowners, buy properties. So why don't you tell us about what some of those other products are, including some that have quite a bit of flexibility, like your all-in-one loan product. Tell us about what all you offer.
Yeah, our special skill set is definitely for investors. While we can do everything, it is kind of a primary focus of ours. And I think one of the real value adds, in addition to the education, some of the other cool things I believe about Ridge, it is the product availability. It's very, very diverse. Fannie Freddie, we've got non-recourse and recourse, debt service coverage ratio, bank statement products, asset depletion products, bridge loans for those fix and flippers, shorter term mortgages. We have commercial loans for commercial properties. Commercial loans can also apply to cross-collateralization of residential properties, if that made sense. Maybe, for example, you want to cross-collateralize 5 of your conventional loans into one non-recourse loan and open up more conventional loans. And then finally, my favorite, I saved the best for last, that all-in-one. This is such a unique product that still a lot of people just are not aware exists. This is a first lien HELOC that doubles as a mortgage and your checking and savings. It combines those two elements, the all-in-one. And it's a means of allowing you to become your own bank. You have this line of credit where your mortgage balance sits, and all the while you're able to deposit all of your depository income versus putting it into your regular checking and savings, same exact banking features, but instead of parking it over here in this vessel, you're simply putting it here and driving down your principal balance dollar for dollar so that the interest accrual cannot pick up speed, right? You're in control. There's so much more to it, but it's a rabbit hole, and maybe we will run out of time if I go down it. But the all-in-one, also interest only, you have this line of credit for 30 years, and you have control about how much interest is going to accrue on a daily basis.
The all-in-one loan. So you, as the borrower, have interest-only flexibility, meaning you only need to cover the given interest payment for that month, or you have the option of paying more. You can pay down some of your principal if you want to. And I know they're at your website at ridgelendinggroup.com. You also have the all-in-one loan calculator, so a prospective borrower can see what their savings might be compared to a different loan type.
Yeah, I really encourage anybody listening, check that out. The online interactive simulator will compare an all-in-one to either your existing mortgage or even a new mortgage. And it's very simple intake, guys. No vials of blood, right? That's my token joke. Very, very simple intake, 2 or 3 pages. The results page is going to be really, really clear on whether the all-in-one is more to your advantage or maybe the 30-year fixed is. The math won't lie. So take some time to do that and see what it says. I might just offer that on occasion, the individual may not be entirely clear about what the input is asking. And if you aren't totally clear and you input something that is not what it's asking, the results page is not obviously going to be accurate. So be sure to check in with us and we'll go over it with you and make sure that the T's are crossed.
Yeah, it's probably worth your time, at least checking on it. Maybe if it's for your primary residence, this could be your biggest ongoing payment in your entire life. They also do primary residence loans there at Ridge Lending Group. So it's at least worth checking out. Again, that all-in-one loan simulator is what it's called at ridgelendinggroup.com. I've certainly visited that page myself. Well, Caeli, we want to get your mortgage rate forecast with what you think rates are going to do shortly. But before we do that, let's talk about something else, appraisals, because you offer loans in 47 U.S. states, almost every state, and you see so many appraisals come in from different regions of the country, typically for income properties. Tell us what you're seeing with appraisals. Are they coming in high? Are they coming in low? Or most of them coming in spot on value? Tell us about appraisals.
They're spot on. I'll tell you, it's probably been, I would estimate maybe 6 months or more. I have not seen a short value appraisal.
Not one.
Not one. Not one. Now, and granted, we do high volume, so I'm not looking at every single one, but I haven't heard of one. I haven't seen one personally. So the sky is falling sound bites that I'm hearing out there in the fringe, I would not give too much credit to. I feel like the values are holding pretty well. No complaints, no issues that I'm seeing there.
It tells us a lot about stable values. Of course, we're beyond those 20% appreciation high flying days that we had in 2021. But because an appraisal is essentially a tool that the bank uses to validate the quality of their collateral, that tells you a lot with what they think about the market. And they're still willing to lend 80% of that because values are so stable in real estate. And they have been this year after they were so volatile last year since they were up quite a bit. Well, let's get Caeli's mortgage interest rate forecast next. I'm Keith Weinhold. You're listening to Get Rich Education. If you're looking to grow your passive income from real estate, pay attention. My Property Stats is a deal analysis tool developed by an active investor to cut the time it takes to analyze any deal by over 90%. For any real estate class, you can calculate the exact price to pay to hit your cash flow and IRR goals. Build a world-class pro forma. Calculate the most you should pay for a renovation, run multiple scenarios with a comparison tool, and more. My Property Stats is the all-in-one toolkit for real estate investors. That means more deals, more cash flow, and more returns. Go to mypropertystats.com/GRE now and use the coupon code GRE to get 10% off your first year. That's just $90 a year for a tool that can save 10 hours per deal. No more spreadsheets, no more juggling multiple files. Use coupon code GRE to get 10% off at mypropertystats.com/GRE. Knowing the difference between a turnkey provider and a vertically integrated rental property company can cost you hundreds of thousands of dollars over the life of your investment. Some companies sell you a property they don't own, renovate it with contractors they don't control, refer you to a property management company they don't manage, all in multiple markets because they can't source enough inventory. That's why truly passive investors work with our friends at JWB Real Estate Capital, perhaps the country's only vertically integrated rental property investment company. They operate in one market, Jacksonville, Florida, and their whole job is to make investing in rental properties easy for you. In fact, because of their vertically integrated approach, their clients have gained 79% more home price appreciation than the overall Jacksonville market since 2013. Find out more about why it pays to invest with JWB. Call them at 904-677-6777 or go to jwbrealestate.com/GRE. GRE listeners can't stop talking about their service from Ridge Lending Group and MLS 42056. They've provided our tribe with more loans than anyone. They're truly a top lender for beginners and veterans. It's where I go to get my own loans for single-family rental property up to 4plexes. So start your pre-qualification and you can chat with President Caeli Ridge personally. They'll even deliver your custom plan for growing your real estate portfolio. Start at ridgelendinggroup.com.
This is Rich Dad Sales Advisor Blair Singer. Listen to Get Rich Education with Keith Weinhold. And above all, don't quit your daydream.
You're listening to the show that's created more financial freedom for busy people just like you than nearly any show in the world. This is Get Rich Education. I'm your host, Keith Weinhold. We've got the president of Ridge Lending Group back with us today. A real treat, Caeli Ridge. She's been in this industry for decades. She's been a real estate investor herself. And Caeli, I joked with my audience before about how I don't feel very comfortable making interest rate predictions myself. They're so difficult to make that I'll ask someone else and let them be wrong about it. I'm sort of joking about that. You're probably not going to be wrong with what you say. In fact, I think that prices of real estate are a little bit easier to forecast than mortgage interest rates are, but I'd really like to get your insight on this. And before you tell us that, Caeli, I think a lot of people are surprised about what's happening. Okay, the Fed had egg on their face because they were too too late to respond to inflationary pressures. And now they're hiking up rates really fast in order to catch up. And I guess I didn't know that Jerome Powell had the guts to hike rates as many times as he has. I'll put it that way. Some people joke that on Jerome Powell's desk, he must have Paul Volcker's book there somewhere on his desk. Of course, Volcker is the Fed chief that famously jacked up interest rates to almost 20% 40 years ago. Yes, that's not an exaggeration. Paul Volcker, former Fed chief, hiked the federal funds rate to almost 20% 40 years ago. Of course, we have the Fed funds rate today at about 4%. Before you tell us about mortgage rates, how much higher do you think the federal funds rate can go, Caeli?
Earlier this month, the Feds met, right? They have their meetings throughout the year. And what I heard Mr. Powell communicate to us and what some of the news outlets were trying to forecast for is that around 5% would be a threshold. I don't know that it'll go up that high. I'm not ready to give my 2 cents on that. But what I can share with your listeners, Keith, is that I believe that while the Fed is very, very clear that rates are going to continue to go up, I think that's a foregone conclusion. I do not believe that they're going to go up in the same trajectory and speed fashion that they have been. I think they're going to level off a little bit, maybe make a rate increase in December, maybe, but not by 0.75 of a percentage point. That's not what my forecast is. Maybe it's a quarter, maybe it's a half, but I think it's going to be a slower progression. And once they do that, I think they're going to ease back a little bit and then watch and see what the results of it, right? Because when those actions happen, when the Fed takes that necessary action to do what they say that they're going to do at any cost, the trickle-down effect or the result of such is not an immediate thing. So I think that what he communicated, what I heard him say is that it's going to be a slower progression, and then they're going to hang back, watch and see what the results of it was or is, and then make the next decisions going forward. So I'll say it again. Here's my forecast. Rates are going to continue to increase by some margin. I do not think they're going to go up as fast and furious, as violently as they have from the beginning of the year to now.
Now, our audience already knows that increases in the federal funds rate, the thing that Jerome Powell and the Federal Open Market Committee sets, that those don't move in direct lockstep with mortgage interest rates. So a 0.75% hike in the federal funds rate, that doesn't increase long-term mortgage interest rates 0.75%. But there is that general loose correlation. A higher federal funds rate over time is generally going to correlate with higher mortgage interest rates, of course. So talk to us some more then about the direction of mortgage interest rates, and to give some context, some perspective, some backdrop here, which is a real surprise to newer real estate investors, is that over the long term, the average 30-year fixed rate mortgage is about 7.75%. That's the rate. So we're still not quite at that point yet. But with that context, what are your thoughts on the future of the 30-year fixed rate mortgage rate, Caeli?
I think it's an important point, Keith, that historically speaking, and investors are going to invest. The investors that have been investing long enough know that the rate is very secondary, maybe even in third place position to making any decision. 7.7 is the historical average. I think that if we're at 7 1/8 today, maybe we get as high. It's such a slippery slope. I'm going to be direct. I'm going to actually answer this question. My forecast is that by sometime between now and maybe spring next year, maybe we hit 7.625. So that's my prediction. We'll see what happens. If I win, maybe I get a prize of recognition. If not, then I can be flogged. But I do think that obviously longer term, we're going to see rates come down. If I'm going to predict that or forecast that, let's say the Fed has said that they plan to start lowering rates in 2024. That was their words. I think it's going to be sooner than that. I think we're going to see some reduction in interest rate prior to that, let's say fall of next year, perhaps. But remember, everybody, rates go up a lot faster than they come down. I know they've gone up really fast this year, but just historically, I would not expect that when rates start coming down, that doesn't mean that they're going to go from wherever the threshold or the height is down a point, or they'll gradually be going down.
And of course, there are a number of factors that govern this. Some of the most widely reported ones are that we still have these robust jobs numbers that come in, which should be good news. More Americans are employed, but of course the Fed fears that inflation is going to continue to run hot, so they will raise rates. So it's like good news ends up being bad news. And of course, they're looking closely at measures like the CPI inflation as well. So what are your thoughts with regard to some of those larger economic forces on this future direction of rates and this very specific 7.625 forecast that you gave us for the spring of next year, which I love that you did that.
It's recorded, isn't it? Okay, we'll see. I think that historically speaking, generally speaking, the better the economy is doing, the higher the rates are. That's just a matter of fact. If we ever find ourselves in a situation where rates were as low as they've been in the last couple of years, something else in our sector, in our economy or worldwide or something devastating is happening that it would drive them down that low. The stronger the economy, the higher the rates typically. I think that the hope is once we get to that place where the Fed feels comfortable, I think that their target is 2%, right? To where they want to see that
Inflation.
threshold. Right. Yep. They'll start pulling back. Remember, you guys, interest rates on a whole should not be dictating whether or not you are playing in real estate or not. That shouldn't be the answer. You should be looking at the investment. You should be looking at it holistically. You should be doing the math. Is there cash flow? What is the appreciation of the home and the rents? What is the tax implication? How can I diversify my portfolio to offset some of these things? Different markets, short-term rental, long-term rental, mid-term rental, notes, or all the things that you already talk about, Keith. That's my answer.
Yeah, investors are going to invest. They don't try to get that market timing just right. And if real estate prices are up, say, 25% in total over the last 2 years, well, if inflation is too, then real prices of real estate aren't up. We already touched on the fact that mortgage interest rates are pretty close to their historic average. And I think what you're telling us, Caeli, is get used to it. They're not going to be below 3% again, at least anytime in the near term or the intermediate term. They were artificially low. So it's really get used to it.
Yeah, kind of. And I think that it's important that we not have those short memories. And as the market cycles shift, that is as certain as death and taxes, we need to shift our expectations. This is a new cycle. So instead of having $400 positive cash flow on the single family residence that we've become spoiled with, now it's going to be $250 or $300. Yeah, get used to it. That's probably the best way to say it.
Yeah, I mean, it's still probably the best place to put your money today. And then the cherry on top of that is if you don't, of course, it is only going to be debased by inflation. Caeli, in there at Ridge, you're different. You have so much repeat business there, including my repeat business. I mean, your company is where I get my mortgage loans myself. I've done my last few refinancings there as well. And part of this is that you're not just merely transactional, you're more relationship based. So tell us about originating a loan through Ridge Lending Group in that process.
Thank you for saying that, Keith. Yeah, I'm glad to answer that. I really feel like we have done a great job of creating an environment for investors, real estate investors, where that holistic approach, it's not just one and done transaction. And if that's what somebody needs, that's perfectly fine. But what we're about is coming up with a strategy based on their goals, teaching them how to understand underwriting guidelines as it applies to those goals and their qualifications. And then the availability of product, we'd be very hard pressed to find an investor that we could not secure financing for. It's really a well-rounded institution, I believe, for real estate investors. And I'm proud of that. And we're good at what we do.
When I think about not being transaction-based, look, what do most mortgage lenders do? Most mortgage lenders are making loans to borrowers for their primary residence. So they're just trying to get that borrower to go ahead and qualify for that loan and not do things like buy their furniture for their new home before they close and things like that, or opening up new lines of credit. And they're just trying to get them closed for that one loan, that primary residence loan. But in there at Ridge, you understand the sequencing of things. You understand that an investor, they might want to buy a cash flowing property in a different state today and another one in, say, 6 months. So you know how to sequence things and see ahead and know to look in their behaviors. Well, wait, you don't want to do anything that might muddy up your debt to income ratio, or else you won't be able to get that next property in 6 months. So therefore, it would probably be better if you proceeded this way, for example, not transaction based, thinking about the long term.
I'm so glad that you're giving these nuggets, Keith, because it's absolutely true. Non-owner occupied underwriting and guidelines and products are wildly different than what that owner occupied is. And the people that focus a large amount of attention in the non-owner occupied lending space is very, very small. So you've got me as the owner of this lending company focusing on investors. You've got loan officers, you've got underwriters, processors, even appraisers, all of these unique people that are in this orchestra of parties that help move the loan are specifically skill setted for investments. And that's what we also bring to the table. And it is very important because what you don't know, you can play yourself out of qualifying, as you said, in 6 months down the road if you wanted to get another property. But let's say that circumstances changed outside of anybody's control. Even if that were the case, we have the product availability that says, okay, you can't qualify anymore for this. We can open up the box of tricks and say, well, we've got this, this, and this. We can still get you the loan.
I've talked to you, the listener, about how the team of professionals that you surround yourself with is often more important than the property itself in real estate investing. One long-term key team member might be your property manager, and another is your mortgage loan officer. And we're talking about why not just anyone can do that for you. So you can learn more and get started and build that long-term relationship where Ridge can really help you see your vision for building cash flow throughout your future. And again, you can do that at ridgelendinggroup.com. Caeli, do you have any last thoughts for us?
Give us a call, everybody. We're here on standby, ready to help you succeed in all your financial and real estate goals.
It has been valuable as always. Thanks so much for coming back onto the show, Caeli.
Thanks for having me, Keith.
Oh yeah, good specific forecasting from Caeli there. You've got to give her credit for that best guess that she made, 7.625% by next spring, and then the Fed starts lowering rates by fall of next year. There are a lot of options for you with someone that offers loan varieties like she does there. For example, what about cross-collateralizing, say, 5 residential loans into just one non-recourse commercial loan like she touched on? That way, you'll also open up 5 new residential spots. The message here is that rates are not going to revert to their artificial lows anytime soon. So get used to what we have today, keep investing, and see what your options are. That's the action item for you this week. Start at ridgelendinggroup.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.